Tariff uncertainty is reshaping global markets. While headlines focus on trade wars and policy volatility, smart investors are asking a different question. How can I protect and grow my portfolio when traditional strategies may not be enough? Today, we'll explore why relying solely on U.S. stocks might not be the best strategy anymore, and discover practical alternatives that could safeguard your investments while capturing new opportunities. Let's start with the reality we're facing. Tariff uncertainty has become what experts call an uncertainty tax on businesses and investors alike. According to BlackRock's recent analysis, we've seen U.S. effective tariff rates potentially rising from just 2% to anywhere between 10% and 20% or even higher. It's not just about the tariffs themselves. It's about the uncertainty they create. J.P. Morgan's research identifies 3 potential scenarios we could face. Scenario 1 involves moderate tariff implementation with some negotiated deals, potentially slowing U.S. growth but avoiding recession. Scenario 2 represents full implementation, which could trigger significant economic disruption and potential recession. Scenario 3 offers a positive resolution with reduced tariff burdens. The challenge for investors is that we don't know which scenario will unfold, and markets hate uncertainty. During the February to April 2025 period, we saw the S&P 500 decline nearly 19% during peak tariff uncertainty, while diversified portfolios with international exposure and alternative strategies performed significantly better. For years, U.S. market exceptionalism made sense. American stocks outperformed global peers consistently since 2009. But this concentration has created new risks that many investors haven't fully considered. Today, many American portfolios are heavily concentrated in U.S. assets, with some investors holding 80% or more in domestic stocks. While this worked during the era of U.S. outperformance, it leaves portfolios vulnerable to U.S.-specific risks like tariff policies, domestic political uncertainty, and overvaluation concerns. Consider the valuation gap. U.S. stocks are trading at over 20 times forward earnings, while European stocks trade at just 15 times earnings. This 25% valuation discount suggests that international markets may offer better risk-adjusted returns going forward. There's also the currency factor. When the dollar weakens due to policy uncertainty, international investments can provide additional returns for U.S.-based investors. In early 2025, European stocks gained over 20% in dollar terms, even though they were up only 10% in local currency terms. Our first strategy involves identifying companies that are naturally insulated from international trade tensions. These are businesses that derive most of their revenue from domestic markets and have limited exposure to global supply chains. Healthcare services represent one of the strongest defensive plays. Hospitals, residential care facilities, and healthcare providers operate in local markets and are largely immune to tariff impacts. According to LPL Financial's analysis, these sectors are actually supporting employment growth and show resilience during trade tensions. Utilities offer another compelling opportunity. These companies provide essential services to local markets, often with regulated revenue streams and monopolistic characteristics. During previous trade tensions, utility stocks showed an 18.8% resilience factor, meaning they declined less than half as much as the broader market during downturns. Real estate investment trusts focused on domestic properties also provide natural protection. These companies benefit from local economic growth and are insulated from international trade dynamics. The key is focusing on REITs with domestic property portfolios rather than those with international exposure. Regional and community banks represent another defensive play. These institutions focus on local lending, have domestic deposit bases, and often benefit from rising interest rates. Unlike large multinational banks with significant international exposure, regional banks are primarily driven by local economic conditions. Our second strategy involves strategic diversification into European markets, which offer compelling opportunities that many U.S. investors overlook. But here's what makes European investing particularly attractive. Europe is home to some of the world's most dominant companies with near-monopolistic positions in their industries. Take Airbus, for example. This European aerospace giant now controls 56% to 62% of the global commercial aircraft market, effectively operating in a duopoly with Boeing. But here's the key difference. While Boeing faces ongoing safety and production challenges, Airbus has been gaining market share consistently. In 2024, Airbus delivered 826 aircraft compared to Boeing's 561, demonstrating clear operational superiority in this essential global industry. Even more impressive is ASML, the Dutch semiconductor equipment manufacturer that holds a true monopoly in the most advanced chip-making technology. ASML controls over 90% of the market for extreme ultraviolet lithography machines, the only technology capable of producing the most advanced semiconductors. Every cutting-edge chip in your smartphone, computer, or electric vehicle requires ASML's machines. This isn't just market leadership, it's technological indispensability. In pharmaceuticals, Denmark's Novo Nordisk has established dominant positions in diabetes care and the revolutionary GLP-1 weight loss drug market. The company controls significant market share in the global insulin market alongside just two other players, and has patent monopolies on breakthrough drugs like Ozempic and Wegovy. With the obesity drug market projected to reach $470 billion by 2030, Novo Nordisk's monopolistic position represents enormous long-term value. The valuation opportunity is compelling. These European monopolistic champions trade at just 15 times forward earnings compared to over 20 times for U.S. stocks, despite having stronger competitive positions. European stocks also offer dividend yields approximately 200 basis points higher than U.S. stocks, providing income while you wait for multiple expansion. The key insight is this: European companies have built unassailable competitive moats. The kind of durable competitive advantages that Warren Buffett seeks, but at European valuations rather than U.S. premium prices. Our third strategy focuses on Asian companies that serve their domestic markets rather than relying on exports to the United States. China offers particularly interesting opportunities in domestic consumption. Chinese domestic stocks gained 15% in early 2025, driven by policy support and reduced tariff fears. The key is focusing on companies that serve Chinese consumers rather than those dependent on exports. Japan presents opportunities in domestic service companies that benefit from structural reforms and productivity improvements. While Japanese exporters face headwinds from yen strength, companies serving the domestic market can benefit from wage growth and demographic changes. India's domestic market offers long-term growth potential, particularly in financial services, consumer goods, and infrastructure companies that serve the growing middle class. The key is selecting companies with strong domestic market positions rather than those dependent on global trade. Implementing these strategies requires careful consideration of allocation and risk management. J.P. Morgan suggests that investors consider allocating approximately 30% of their equity exposure to non-U.S. stocks, with portions directed toward European and Asian opportunities based on individual risk tolerance. The key is understanding that diversification works best when assets have low correlations. During the February to April 2025 market stress, bonds gained 1%, alternative strategies gained 5%, while the S&P 500 declined 19%. This demonstrates the power of true diversification. For practical implementation, investors can use ETFs focused on European domestic companies, Asian consumer stocks, or U.S. domestic-oriented sectors. The goal is building a portfolio that can perform well regardless of which tariff scenario unfolds. Risk management involves regular monitoring of policy developments, valuation changes, and performance attribution. As tariff policies evolve, portfolio allocations may need adjustment to maintain optimal diversification. Tariff uncertainty isn't going away anytime soon, but it doesn't have to derail your investment success. By diversifying beyond U.S. stocks into domestic-focused companies and international markets, you can build a more resilient portfolio that's prepared for multiple scenarios. Remember the three key strategies: focus on domestic-oriented U.S. companies in defensive sectors, explore European opportunities driven by defense spending and infrastructure investment, and consider Asian domestic consumption themes that benefit from local growth rather than global trade. Take time to review your current portfolio allocation. Are you overly concentrated in U.S. stocks? Do you have exposure to companies that could benefit from domestic market growth? Are you positioned to benefit from international opportunities? The goal isn't to abandon U.S. markets entirely, but to build a more balanced, globally diversified portfolio that can thrive regardless of what tariff policies bring. In an uncertain world, diversification remains your best defense and your greatest opportunity for long-term success.